Hi, I'm David Daughtrey with Copperwynd Financial. Today I'd like to talk a little bit with you about a situation that's occurring in the financial markets that you're probably not hearing much about. It's in the repo market. And the repo market has nothing to do with repossession of a car or anything else. It's the repurchase agreements. And that is a market where large institutions, banks, money market funds, hedge funds, large financial institutions fund between $3 and $4 trillion overnight every day. So it's a very large market, and it's generally one that has functioned very well since 2009. That's the last time that the Fed was really involved in that. Now, what this market does is it's a sale and repurchase agreement of predominantly Treasury Bills, which are very short-term maturity instruments, government securities. Sometimes they'll also do it with mortgage-backed securities, but generally it's Treasury Bills, which are sort of the most liquid market out there. And what's occurred is in the last 3 months, starting back in September, this market, which usually trades at 1.5 to 1.6% annualized, and they do it on an overnight basis, all of a sudden in September, overnight went to a 10% annualized rate. And the Fed stepped in and started lending in this market. One of the things that you can see is that the market goes up nearly every week when the Fed is increasing their balance sheet in the repo market. And the 1 week they didn't, it went down. The other thing that you can see by this chart is that the Fed, their balance sheet had been going down and then finally stabilized. And then in the last 3 months, it's been a hockey stick going up. And all that is the Fed printing money out of thin air and buying these T-bills and mortgage-backed securities in the repo market. And that's been nearly $400 billion. The issue is if everything is going very well, if you're looking and saying, well, the stock market's hitting all-time highs, the economy is doing really well, you look at GDP, you look at the unemployment rate, you look at wages, you look at consumer spending, all of that is in great shape. If everything's great, why are they having to put nearly $400 billion into this very liquid market? There's lots of hypotheses of what's causing it. None of those have been proven to be correct so far. Now, what we are seeing is the amount of funding that they're having to provide in this market in the last week or two that goes over 12/31/2019 has dropped. And so people are saying, oh, they've got it under control. Well, what I see happening here is we've got the symptom under control, because nobody really knows what the underlying issue is. There's lots of hypotheses about it, but none of them have proven to be correct so far. So we're concerned about this because they have effectively pushed in nearly $400 billion into the financial system. And if they've done that when things are going really well, I think what you're seeing is the last 11 days, you've seen the NASDAQ go up every day and all the markets hitting all-time highs. If that's the case, what happens early next year when they let this start rolling off? And so instead of pushing into the financial system $400 billion, they're sucking out $400 billion. That could have a significant negative impact on the markets. So we're concerned about that. We're looking at it. We're following it. Not many people are, and we think that's important to be looking at because it's a big thing. Thank you very much.